I am Rob Thummel, Senior Portfolio Manager, and welcome to this week's Energy Quick Take in 10. Okay, so I thought what we would do this week is talk about something we recently published on our website. We do it every year, and specifically it's our mid-year outlook, investment outlook for pipelines, gas, and growth. Okay, so you can't do a mid-year outlook without a little bit of context to where you came from, right? And so where'd we come from? Well, first half of the year across Tortoise investment products, it's been a really good start, right? If you think about what's happened, the performance of midstream energy infrastructure is up about 20%. The performance of AI infrastructure has been even better as we've gotten off to a really great start. And we'll talk a little bit more about where we're going on AI infrastructure and energy infrastructure as well, and then we'll finish up by looking at where we think we go in the next 6 months as well. Let's talk about where we're going. Okay, so what we talked about for months at Tortoise is electricity is the new oil. And we've talked about how the age of electricity is upon us, and that's going to strengthen demand for all energy products. And what's the fundamental driver of that? Well, we highlight in a chart in our outlook the hyperscaler CapEx expenditures. And if you go back and you look, 2025, excuse me, hyperscaler capital expenditures were $400 billion. Last year, hyperscaler CapEx expenditures were closer to $700 billion. They're probably going to $800 billion. They're probably going to go to $900 billion. Jensen Huang thinks they'll go to $1 trillion, maybe $3 to $4 trillion by 2030. This is significant because this is where the U.S. energy sector comes into play, because this is why electricity demand in the U.S., and you've heard us emphasize it before, is absolutely going to be critical going forward, because we're going to see electricity demand in the U.S. Grow tremendously. It's going to grow 2 to 3% a year, and it's going to grow that way for decades, actually well into 2030 and beyond. And a lot of people say, well, what is 2 to 3% a year? Well, 2 to 3% a year of electricity demand growth is the same amount of electricity that the entire city of New York City basically consumes in 1 year. So we're going to be adding in New York City for year after year, year after year, maybe decade after decade after decade. So the question then that we often ponder around Tortoise is then what's going to fuel that electricity demand? And what we highlight in our piece is that we think that natural gas is the clear winner and will be the primary fuel supply source to generate electricity going forward. It wins for a couple reasons. First of all, we have an abundant supply of low-cost natural gas. Right? In the U.S., I was just looking on my Bloomberg terminal, and natural gas in West Texas right now is below $1 an MCF. Now think about what that is. That might not mean much to you, but in the U.S. price right now is about $3. I think like I said, West Texas is below $1. In Europe, natural gas prices are 6 or 7 times that. There's $6 or $7 an MCF, right? And so the strategic advantage of the U.S. is its energy supply. And in a world where energy security is even more important, well, access to low-cost natural gas is what's going to help the U.S. Ultimately win this global AI race. And as a result, natural gas demand will grow substantially. And natural gas demand will grow not only to fuel electricity, but because of energy security, other countries around the world, we expect, will continue to buy more and more liquefied natural gas from the U.S. as well. Okay, what else though? Is it all going to be about natural gas? We get this question a lot. Is the U.S. going to be able to does it have enough natural gas to supply to win this global AI race? And the answer is yes, we do believe that, but nuclear is going to play an important role as well. Nuclear energy has already gained prominence, And obviously it's got the eye of the Trump administration to grow market share as well. So while natural gas will continue to gain market share in a growing market, nuclear power, nuclear energy will gain market share as well in a growing market as well. And so we'll see that going forward into the future, and there'll be many companies in the electrification industry that operate nuclear facilities that will benefit going forward as well. Okay, so how's the U.S. going to keep up with energy pricing and it being secure? Well, the predominant way that happens is, the U.S. is the largest producer of oil and gas in the world. The U.S. also operates the largest pipeline network in the world. And so the U.S.'s ability to transport natural gas, oil, natural gas liquids, ethane, propane, butane, is all predicated off of this large natural gas pipeline network that makes it very efficient to supply these energy supply sources at a very low cost and in a very efficient manner. Okay, so what do we expect, or what are we watching as we move into the second half of 26? Well, probably at the top of the list is AI activity, right? AI. We want to see that those hyperscaler capital expenditures, like I said, went from $200 billion to $400 billion to $700 billion. Are they going to $1 trillion at some point in time in the next few years? Are they going to $3 to $4 trillion? Because all of that, which we think will happen, and the continued build out of AI applications, and if you think about it, AI applications need AI models. AI models, they need electricity supply, right? Or AI models need AI infrastructure. AI infrastructure needs electricity supply. And electricity supply is really that foundational level of what Jensen Huang calls his 5-layer cake. And so we're going to be watching that very closely as we continue to see more and more need for that lower level or that base level of electricity, more need for AI infrastructure, and we think that natural gas will play a really important role going forward as well. Okay, what also will happen, we think, in the second half, and this is going to be really interesting. We've started to see a little bit of this already. Emerging players in power generation, right? The big need for, if we're going to have all this power, where's it going to come from? We know what the supply source is going to, where the supply source is going to be, but what companies are going to provide that power? The government, the Trump administration has brought this mandate: bring your own power to the hyperscalers. What does that mean? It means the companies like Meta are going to have to partner with companies like Exxon or Chevron, and Chevron in this particular case is what they've already done, to build power centers, to build power and electricity generation facilities, to power these data centers of Meta's. And so we'll see more and more of that, we think, going forward. We're going to see more unique solutions, like behind-the-meter power solutions, like what Williams is doing. We'll hear more and more about that in the second half of the year as the world and the U.S. looks for ways to generate electricity, low-cost electricity, but have those costs of that low-cost electricity be borne by the hyperscalers and not by the retail consumer. We'll also see a little bit of opportunity in regulatory and policy shifts. If you think about what's going on policy-wise, in the first half of the year, we saw the Jones Act waived, so that you're able to move things like gasoline and diesel from the Gulf Coast to the East Coast and to the West Coast, because once the Iranian war hit, that caused significant disruption when the Strait of Hormuz no longer could see ships go back and forth. And so all of these things, from a regulatory perspective, will help affordability, right? Low-cost natural gas will reduce affordability for electricity and really other manufacturing facilities and other industrial activity. Low-cost oil will reduce the cost of gasoline, diesel, jet fuel in the U.S., especially relative to other areas in the world. But it's also an opportunity for the U.S. energy sector, because it will mean more exports of all energy commodities, whether it's oil, diesel, jet fuel, or in the case that we've been talking about forever is liquefied natural gas. And then the last thing that we think that the second half of the year will bring is technological catalysts. So what are we talking about there? We're talking about growth in AI data-driven data centers. We're going to see a lot more data centers around the U.S. be built. They're going to be built in regions where there is demand for electricity, and there are a large number of electric generation facilities. So we're going to see a lot of facilities built, a lot of data centers be built in Texas, in the ERCOT region. We're going to see a lot of data centers be built in the PJM, the East Coast, and we're going to see a lot of data centers be built in places like Arizona. And we're going to see a lot of pipelines, natural gas pipelines in particular, be built to connect low-cost natural gas from South Texas or West Texas to places like Arizona, or to other places in Texas as well. Okay, so I think that, and the other thing I should before I end, obviously the biggest thing to watch, though, from an energy perspective in the second half of the year is the Iran conflict. That's going to be really important to see what happens with Iran. We've had a ceasefire that lasted, I think, 21 days. As we sit here today and record this, the ceasefire is, I guess, has been broken up. Maybe by the end of the day, we'll be back to a full ceasefire. But we're going to see ups and downs in the ceasefire. That means the energy price, the cost, or the oil price is going to be up and down. But I think the interesting thing about the first half of the year was, even though we saw oil prices go up and reach record levels, and then oil prices came back down and declined in June by 20%, we still saw really strong performance out of the energy sector and in the energy infrastructure sector. And then, of course, we still see huge opportunities in the AI infrastructure sector, as we expect AI hyperscalers to continue to grow their capital spending, which then ultimately trickles down to the enablers of AI. Okay, so thank you for listening today. We look forward to all of your questions, and look for us with our next quick take in 10.